What's going on, everybody? This is the Blockchain Backer, bringing you the latest cryptocurrency news and analysis. Today, we have an interesting video here. We're going to be trying to integrate in the Bitcoin price action, the cryptocurrency market, into what's been going on out there in the macro environment of the world, or the macroeconomic world. One of the big topics out there recently, and really kind of all the time, but especially right now, has been what's been going on with the Federal Reserve, signaling quantitative tightening, balance sheet roll-off, rising of interest rates, and what the intention is of the Federal Reserve with battling inflation, which we're all familiar with. We all see it everywhere, from the price at the pumps to our groceries to our goods that we buy to energy to rent. Inflation is everywhere, and the Fed is signaling that they want to fight against it. So if you guys are familiar, a friend of the channel, TXMC, who has the YouTube channel Alpha Beta Soup, and over there on Twitter at TXMC Trades, has joined me on today's video. He recently put out a video titled "The Fed Wants to Destroy Wealth to Fight Inflation, plus Bitcoin's History with Quantitative Tightening," or QT. I thought it was a phenomenal video. I thought it was very interesting. I see a lot of people out there worried about the Fed, and I figured, hey, let's have him on. Let's just talk about it. I primarily focus on the charts. That's where all my attention is. Some people take a look at other places. I thought it'd be great to at least go into it. So, welcome, TXMC. Thank you for joining me on today's video.
Happy to be here, BCB. Let's do this, my dude.
My man, thank you very much. You know, we're very friendly with each other, so I enjoy bringing you on here. It's easier for us to banter back and forth. I watched your video. I thought it was so good, where you kind of dived into what Jerome Powell was saying here in this interview, signaling that, hey, there might be pain ahead, but we need to do whatever we need to do to battle inflation and get prices down. Essentially that, hey, this economy can't run without inflation cooling off. No economy can go without inflation cooling off. So in this video, I think, what we're going to do is kind of have you just kind of run through some of the things and situations that we have going on with the Federal Reserve, what they're signaling, what they're saying, and then we'll kind of talk about, whether or not that seems feasible. Again, let me preface this. TXMC and I are not experts on the Fed. We spent some time looking at this. It's one of these things. It's just going to be kind of podcasty style YouTube video. We're just going to kind of chat about it and see what we can see from it and the problems that are going through our own minds with what is happening here with the Federal Reserve. So first things first, I'm going to hand it over to you for a second, TXMC. I may interject a little bit, but can you kind of give us a state of where the Federal Reserve is at right now, the problems we're dealing with, and what they're signaling that they want to do?
Yeah, I'd love to do that. And as you said, I'm not a professional economist. I'm just an independent researcher. I'm a market participant. So everything I express here are just my own views and interpretations of the market. So with that said, the Federal Reserve has a serious problem on their hands, and it is inflation. And inflation in a midterm election year. So the problem with inflation truly is that it's out of the hands of the Federal Reserve at this point. There's very little that they can do to make it come down, because the inflationary pressures are coming from supply shocks predominantly, especially in commodity markets, with the shutdowns going on over in China, with the war between Russia and Ukraine, which are two major commodity exporters. There are a lot of factors, and those things are completely out of the purview of the Federal Reserve. However, price stability and full employment are their mandates, and those things are very difficult to maintain in an environment where we have inflation higher than it's been in 40 years. So they're in a very tough position right now, where they are essentially managing sentiment more than they are enacting any kind of policies. And what we've got here on the screen is an interview that he did last week, that Jerome Powell gave last week to Marketplace. And it was kind of a really telling interview, I felt, and it was the subject of my most recent video that you mentioned. And in this interview, I feel like we get a glimpse into the mindset of a person who's making some of the most impactful decisions on society right now. And it's really interesting to me to look at the wording. I'm not a Fed expert, but I do like to pick apart people's language and roll those in with their stated intentions and try to get an idea where there's disparity, right? And when you have these guys like Jerome Powell and these other Fed governors who give comments and interviews and whatnot, A lot of times those are pre-approved, but sometimes, like in this interview here, you can catch some of their responses being a little off the cuff because these aren't prepared comments in a lot of ways. He's trying to answer questions. And so you get a glimpse into their thought processes, and it can be in times more revealing than looking at like prepared speeches.
I found it very interesting. I know you're going to dive into it too, but that he's coming off very direct
Right.
in this. So, and that's very different from what we see usually in his speeches, right? Don't you think sometimes in his speeches we did kind of a bouncing around trying to kind of protect markets, but in this thing he was pretty direct.
I think so too. And again, in his speeches, a lot it's very prepared. Those words are combed through very carefully, and so that's them presenting like a cohesive vision of their policy choices. Whereas when he's in an interview like this, it's a little bit less of that. It's less packaged, and sometimes you can really pull insights out that wouldn't be in his formal pressers.
Yep.
So the thing he really starts with, and I'm scrolling through this, but we're not going to read it all, but I'll try to point out some of the pieces that caught my eye. And the first thing he mentions is we can't control demand. Or I'm sorry, all we can control is demand. We cannot affect supply with our policies. And so the question about whether or not we can execute a soft landing may actually depend on factors that we don't control. So there is some coded language in here. Soft landing is an econ term that means slowing growth in an economy without entering an official recession. And that's like the golden target of the Federal Reserve, is to thread this needle to slow the economy down enough that inflation comes down in their minds, even though we've stated that they can't really control inflation directly. They're hoping inflation comes down without sending us into a recession. But he's saying here in the first comments of the entire interview, the soft landing may be completely out of our control. So he's basically saying it's a tacit admission here that the inflationary forces on the market are not within their purview to lower them. They can only attack them indirectly. So that sets up the theme of this conversation.
And so, like, what they're talking about here is they're talking about controlling demand. So another way to kind of like fight inflation is to increase productivity, right? If we become more efficient at things and we can make things happen faster, if you open up a bunch of factories that can produce these things at low costs, that can help satisfy the demand, that can bring down the inflation on its own. But it's appearing that that's not within their control. Like they're saying, we can't control that supply side. The only thing we can control is the demand side. So in essence, trying to bring the demand function down since the supply is completely out of their control.
Exactly. Yeah. It's a fraction, right? You can think the demand is on the top and the supply is on the bottom. And so you lower one and the other one raises.
Right.
And you're right. Like abundance can be deflationary, right? When we have innovation, those things can be deflationary. And likewise, when we shut down economies like we did in 2020, that can be it is in the immediate term deflationary, but the response to it in an effort to protect the economy from cratering on itself, we created inflationary forces. So what we did was we sent everyone home, we shut down the service sector, we gave everyone a bunch of free money, and we interrupted the just-in-time global supply chain. And so we killed demand for services, gave a bunch of people free money and sent them home. And so what they did was they all started buying goods with it. And once we reopened the world economy, the supply chains since then have never really caught up. That created a lot of logistical inflationary forces that we're still working through. And during that whole process last year, while we were seeing these things unfolding, we started hearing more about what's going on in the ports in China, like all these complications and the kind of ripple bullwhip effect of that. We had the Federal Reserve telling us that we didn't have to worry about inflation. Even though we created 40% of all of the dollars in existence in a 2-year period, we don't have to worry about inflation. It will just go away on its own.
Right.
That was their wording when they were telling us a year ago that it was transitory. That was them saying, we don't have to do anything at all, and inflation will simply fix itself. And what we have now learned, and what I believe they did not fully grasp at the time, is by interrupting the global economy the way that we did in 2020, and then overstimulating as a way of trying to rescue it, we created this inflation. And it's now fully out of the hands of the Federal Reserve.
And that's a problem that a lot of people have, including me, is that, that they didn't know that this was going to happen. That if you, like, for example, like, if you're employed in the United States and your employment was not impacted by what happened with C-19, you maintain your full-time job. As a family of four, you're still getting, $6,000 checks coming in the mail, right? And
Right.
on tax returns, if you had health insurance marketplace plans, you didn't have to pay back any of the credits if your income was over a certain amount. Like, you got a tax refund on credits. There was so much free money still given to regular people who maintained their jobs and were not impacted by C-19. And that, even the everyday person in the world recognized that inflation was going to come, that if you suddenly stop the ability for supply to enter, or if there's a slowdown in the economy for supply and production to happen, but then you suddenly just slam a bunch of money in people's laps, the minimum amount of supply that's out there, then you have suddenly overwhelming demand because there's all this extra free flowing money, this disposable income that all these people have. Of course, they're just going to be able to freely buy up the limited supply that there is. And then what happens when you do that, if you're a business owner, you're going to have to raise the prices to slow down the velocity of that somewhat, because you're not going to be able to get your supply fixed. And like, those are just simple business economics on how things work when you're managing a business, that if you're running out of supply, you have to raise your prices. And if the consumers are just throwing their money at you, like the meme from Futurama, shut up and take my money, they were, they're just throwing money at them, and they don't have enough inventory, and then, we can get into supply bottlenecks and all that stuff in a little while. But it was so obvious to everybody that inflation was coming and inflation was sticking. That's a problem that people have with the Fed right now, right? Like you were just talking about. Do you really think that they, of course, this just becomes an opinion and a speculation. Do you really think they didn't know that? Like, were they being honest with that, or was something else going on there? Like,
I think part of it is their chosen economic indicators. Like, there's a lot of data they just don't prioritize. They have their chosen indicators. I'm not an expert on all of them.
Yeah.
But I think part of it is they were also just trying to massage sentiment. I mean, a huge tool in their box is forward guidance, and Jerome Powell is a master of the pulpit. He would much rather get the market to do the lifting for him rather than using the blunt instruments of policy tools. And he's very good at that, and he's gotten better at it over time. And I think that last year was a massive psyop massaging sentiment campaign by the Federal Reserve, because you can't, if the economy, at that point, the economy was still humming. The S&P was still setting new highs. And so you don't want to interrupt that process. And I think they didn't take seriously how quickly things would unwind in the commodity markets. And also, we have to be honest that the war between Russia and Ukraine was not taken seriously. I think a lot of people discounted the chances that would actually happen. And also, China locking down again here in the first half of this year has also had a major impact on supply shocks, and will continue to for probably a few months. Even if they open back up, that stuff doesn't just go away. And so I think those factors were not planned for 1 year ago today. And so they maybe have caught some of that. Some of that might have caught them by surprise. But
yeah, well, sorry, we'll get on all those. I'm sorry, I derailed you there, but let's do this. My bad, man.
No, this is all really important, and it's such
Right.
a big topic that we bring up one thing and it creates tendrils into other subjects.
Exactly, man. That's the complication with all of it, is that there's so many moving puzzle pieces happening in here that it gets a little convoluted on all of it. But we'll keep going.
Right. And so throughout this interview, the point that he keeps trying to get across, there's a couple of key points that he tries to make. One, All we can do as the Federal Reserve is try to slow down demand. We have no control over supply. That's him telling you there are certain factors in the global economy they have zero control over. And I think that's what they're talking about here when they're emphasizing how they can control demand and supply is out of their hands. They also continue to state that they are intent on getting inflation down to 2%, and they have the strong desire to do so. Now, I would like to suspend belief momentarily about whether or not we think they can actually get there, because I don't really think that's the point. I think the point is them setting expectations and massaging sentiment until they are forced to do something different, because that's what they have historically done. They're just trying to keep the plane in the air, right? They don't have a destination. They're just trying to make sure the plane doesn't come down. And so that leads to, that's a great analogy that my buddy British Hoddle gave me that really helps frame how to think about the Fed's outlook and their mandates. They don't have an end goal necessarily. It's a moving target at all times because they're just trying to keep things in motion. They just don't want the plane to land. And so what that leads to them overreacting to deflationary periods and underreacting to inflationary periods. And then when they find out that they got something wrong, they tend to hike us into some kind of an economic crisis. That happens so often. And it's hard to believe that this would be any different, frankly, because in the past, every tightening cycle has ended with some kind of a recessionary period where they have been forced to back off of their policies. And in many ways, it appears that that's kind of where we're heading now. But the inflationary supply shock forces going on outside of the US's borders are really making it complicated because it neuters their ability to address domestic monetary problems.
Right, because the inflation that we're dealing with is not just a United States phenomenon, right? This is a global phenomenon.
It is. It is. Everywhere is having high inflation. We just found out this week that in the UK it hit 9%. I think in the Eurozone it's like 9 or 10%. And just like we are experiencing here, that's like a 40-year high. You know, it's affecting everyone. But interestingly, the United States median income and the Canadian median income were the only two out of the G7 countries that went up in 2020. If you use data from the OECD for median income, they show that there are the only two G7 countries whose median income rose in 2020 was the US and Canada. And it's because we overstimulated. And it created a type of wealth effect that has rippled for the last couple of years. But it also shows that other economies did not stimulate in much of the ways that we did, and their citizens are dealing with the effects of this economy in much different ways. Their lifestyles have been affected more heavily. So, you know, he goes on and he starts trying to hem and haw about how we're facing different challenges, but everyone's facing the same challenges. So another thing he mentions in the interview here, there was a big push in the market in the beginning of May when he took 75 basis points, quote unquote, off the table in the FOMC meeting at the beginning of the month. One of the reporters asked him if they were considering 75 basis points, and Powell's answer was no. Well, in this interview, he puts it back on the table. And he puts it on the table by saying, well, when I answered that guy's question, I was just telling him that we didn't consider it in the meeting we just had. I didn't mean we weren't considering it for the future. So you can see how what they tell you at any given point is just what they're telling you at that moment. So that's what makes this really difficult. We have to kind of look beyond their words and think about their historical track record and what they actually might be able to do to fix these problems, which are very few in number. The options they have are very few in number.
And that's one of the things that's confusing about the Fed is being able to read them, right? So like, you know, it was back then on May 4th, I believe, is when that meeting happened, and they took 50 basis points off the table. You know, the Dow Jones Industrial Average pumped up 1,000 points. And then, you know, here we are 6 days or, 8 days later, this thing gets released, and it's almost like backtracking, and really, instead of being like a massaging of the market, this thing is very direct. This is different from what we've seen from the Fed over the course of the last several years, where the Fed is really trying to protect markets and be real calm and collective about the words that they're using, like we saw in the most recent meeting back there on May 4th. But this thing is so direct. It's just like, yeah, no, 75 basis points, it's back on the table. It's almost like this was a correction to come out to the markets to backtrack on what happened back on May 4th. You follow what I'm saying?
Absolutely. Yes, absolutely. I think it's all a sentiment game for them. They're just trying to keep the market from completely imploding while also not allowing it to rip in their face while they are presenting a serious case about inflation.
Right.
So here's the crux of the interview, I think, for me. This is one of the parts that's really informing my general thesis about what I think they're doing. So here's where he starts talking about the labor market. So again, the dual mandates of the Federal Reserve are price stability and full employment, which are already difficult to balance. Those two forces can be counterproductive for each other. But in this paragraph here, he says, employment is very low. The labor market is extremely tight. And he goes on to say, there's too much demand. In the labor market, there's more demand for workers than there are people to take the jobs by a substantial margin. So wages are moving up at unsustainable levels, right? The demand for labor exceeds the supply of labor. He says there are 2 job openings for every unemployed person. So in principle, you could moderate demand, reduce demand to the point where job openings move down substantially and the labor market gets closer to being in balance. So what he's saying here, they believe, and the Federal Reserve, this comes back to the indicators that they use. Their measurement of labor market strength is on 2 values: job seekers and open jobs. They don't care about labor participation that much. They don't really seem to be overly concerned with the demographics of those workers. You know, the working force, the working age population, the size of it has been shrinking as boomers are retiring. The birth rates are declining. And so we have less and less labor participation. That's one thing that's weighing on the economy that's been happening since basically the dot-com bubble. But also they believe here, because they have such a binary way of looking at employment, that simply because there are twice as many open jobs as there are people officially looking for jobs, that they can continue to do this aggressive dance around inflation, which causes asset prices to come down, while not affecting the underlying labor market. They think that they can essentially cut job openings in half because there's 2 openings for every person, which is a historical high. It's never that high. Like from that perspective, labor is as tight as it has ever been. Now, let's just forget for a moment that the types of jobs that are currently open might not align with the people and the skills that are looking for jobs. That doesn't seem to matter to the Federal Reserve. It also doesn't seem to matter to them which sectors might undergo layoffs. As long as there are plenty of openings for the people looking for jobs, they're happy. And that to them signals that they have a runway to continue being aggressive. So what I think that this means that they are not at a place yet where they feel the need to pull back on their aggressiveness, to pull back on their hawkishness. Now, the bond market, everyone's been talking about the yields in the bond market. They've risen at an aggressive pace, like the fastest they've ever risen. And they've essentially, the 10-year yield, the 5-year yield, the 2-year, they've all reached up to their previous highs. And it's very rare that they go above them. It's a 40-year paradigm of rates continually setting lower highs. And the bond market has tightened about as far as it can go.
Right.
But even despite that, the Fed is still telling us that demand is too high, the labor market is plenty strong, and that they are serious about inflation. So for them, the euphemism here is the tightening of financial conditions. That's the phrase that they always use. In Fed speak, the tightening of financial conditions is analogous to the lowering of asset prices. The reason for that is that we have an economy in the United States that is powered by the consumer. It's powered by spending. The consumer is 70% of our GDP. It's 68% to be specific, rounded up to 70. More than 2/3 of gross domestic product is people spending money on goods and services. And when you have the Fed stating that demand is too high. Now, we've already expressed that much of the inflation is actually supply shocks. It's not necessarily that everyone is continuing to pile into, risk assets and they're blowing everything up. There are deflationary forces on the consumer that is making their money go less far than it used to, and there are signs of it weakening. But even though we've had all of this tightening, the Fed is still coming out and saying this isn't good enough. We need things to be tighter.
And so to put it in a way of saying like, okay, they see an issue with the unemployment rate. Not that it's good that unemployment is low, but that it's too low because there's too many job openings that are open. And so the way you could think about that is that employers don't want to let go of employees because they're hard to find, or that because the labor market is so tight that the offerings that these companies have to do for these job openings, they have to offer these really high wages. Or since employees know that they're valuable and that they can go find another job elsewhere, these employees are having a little bit more kahunas to come up and ask for a raise. And just that because the labor market is so tight, that means that
people don't feel poor enough yet.
Yeah.
To put it bluntly.
Yeah, and because they can get a job, and because the companies are forced to fork up the money to pay well for these jobs. So
so I see a disconnect there, right? Because as we talked about, there's no discussion from the Fed about the quality of these jobs, about the skills required, and how that aligns with people who are looking for jobs. There's no talk about that. So they just believe that just because there's a lot of open jobs, there's a bunch of people who feel comfortable enough not to take those jobs, which to them states those people aren't experiencing inflation in the way that it's printing month over month on the CPI report. And so for them, conditions don't appear tight enough yet because the consumer hasn't fully weakened yet, But I think this week has been an interesting one because we're starting to see retail earnings look really crappy. And if that trend continues to unfold, if people are forced back into the workforce and we start to see that disparity collapse, that could be deflationary in a sense.
Yeah, I have a whole lot to talk on that, and we will today.
Yeah, and I think that that's coming. I don't think that the Fed is going to tighten us into the Great Depression. I don't believe that, but I think that they are looking at incorrect data, like their puzzle of the economy is maybe slightly skewed because they have certain indicators they like, and those are the ones they stick to.
And that's a problem that I have because I can see other things in the economy to say, if they go forward with going crazy, I mean, you're going to see bond yields break out, you're going to see the dollar break out, and then you're not only that, they're just like missing the big picture. You can paint the picture, the Fed can paint the picture of how great things were a couple of months ago. But like you just talked about with those retail reports coming out of Walmart and coming out of Target, that's my wheelhouse. I know the direction all of that's going to go in for those big box retailers right there. And that those and that massive amount of inventory that they have sitting on their shelves right now points big fat signs that those companies are going to be laying off a lot of people coming soon. So there's already this deflationary force at play that doesn't require the Fed to go all the way in, right? It's coming. The consumer is already getting tight with their money, and we'll get into that here in a minute. But I think, so far, what have we stated? Powell has come out and he has said inflation is too high. We don't have the ability to fix the supply shocks. The thing that we can try to do is try to control demand, and we are committed to that we're going to do everything within our power to try to bring demand down, even if there is some pain involved with that. We're hoping to have a soft landing. We're hoping not to create any type of crazy unemployment, but we're committed to doing that.
Yes, absolutely. They are. And I don't think that they're necessarily purposely coming into meetings every day and going, we need the S&P to go down. But I do think that they look at the tightness in the labor market and they see, you can look at the VIX. The VIX hasn't gotten above 39. There's signs that the market this has been kind of just an orderly drawdown. And I think the Fed is playing a game of chicken with the labor market. And all these deflationary forces that are stacking up, retail sales rising while EPS is falling, inventories expanding. You're hearing about freezes in certain sectors, straight up layoffs in other sectors, that all of those are very, very deflationary forces. And, I mentioned a few minutes ago that the working population has been changing. There's a lot of new retirees that have, that have spawned over the last few years. Some of those people, if inflation continues to remain elevated because of these commodity shocks, which really the Fed can do nothing about those things. And there are a lot of smart people out there that believe that we haven't seen the end of rises in commodity prices because of baseline supply issues, production issues that demand cannot be destroyed for. That those if those factors continue to play out, and inflation doesn't come down while the labor market is softening, you could see boomers re-entering the workforce. That would bring wages down significantly because those people already have income. So they're not bidding up the wages for the jobs that they're competing for with their kids on. They're just re-entering the workforce just to make some money. That's a deflationary force. High inventories are a deflationary force. No one buying the products on your shelf in the first place is a deflationary force because they can barely afford gas and milk. So there are a lot of these things stacking up, and it's possible that the Fed continues this dance all the way into a mass deflationary shock, which is painful and forces them to change their policies. I think there are a lot of people banking on that, and I would give that a realistic probability sometime in the next half a year or something.
And that's the big problem here, right? So that's why there's so much confusion out there in the market, is that one, the Fed has been inconsistent on their messaging in the past, especially with, transitory inflation. And, if for those of us who were, or for those who were paying attention to the Fed back in September of 2019, they were bailing out the overnight lending market. So the banks, there weren't enough banks lending out money overnight in order to satisfy the reserve requirements. And the Federal Reserve was coming in and bailing out overnight lending markets. And the first night, it was like $50 billion back in mid-September. Then the second night, it was another $50 billion. And financial Twitter, everybody's losing their mind of what is going on. Why is the Federal Reserve bailing the banks out in the middle of the night in the overnight lending market? And then they came out and they said, hey, this was actually just, to pay some taxes. And we knew this thing was coming. And this is nothing. This is a nothing burger. It's going to move on. And everybody's like, okay. But then that night they do it again. And then that next night they do it again. They do it all week. And then the number stacks up. And they just start doing this more and more and more, going all the way until C19 happens. So the point, it was getting to like hundreds of billions of dollars per night were being used in this overnight lending market, bailing these banks out who were not able to satisfy their reserve requirements due to a liquidity issue. And then boom, when C19 hits, when the market falls out from itself, what does it do? It goes down in a straight line. No liquidity there in the market. So, then of course, narratives change, Fed opinions change, and we can see how quick these things can turn around. And like you're saying, how far can they take this before they have to revert back? And so, we've seen them not being transparent in what was happening with the overnight lending market back in September of 2019, then saying everything is fine. And then boom, the market falls out from underneath itself. And then we've also seen them say inflation is transitory and it's not an issue, when everybody and their mom knew that this inflation was sticking, but they said it wasn't. And so then, the credibility factor it's tough here, because they're sitting here saying, demand is still really high. We want to bring demand down, but then there's all these other deflationary pressures that are already existent out in there. And you say to yourself, can the Fed really actually do this? Like you were saying, how long can they really go on with this unless something actually ends up breaking? And then the Fed changes what they're doing all over again. Like just in the last 3 years, multiple changes have happened, right? They can come so quickly. They can change what they're going to do. In 2018, they were doing something like this, raising interest rates till things broke. Boom, they had to revert back the other way.
Right.
And so the challenges we have here of being like, they're saying this, but where's the breaking point where it doesn't work anymore? Or are they really going to do what is looking like are they going to break the whole economy? Right.
Right. Yeah. I think that if you look back at their history, usually they begin tightening and then they end it when we hit some kind of a recession, right? They tighten us into a recessionary period. But they're actually now embarking on a hiking schedule when growth is already slowing. First quarter GDP growth was minus 1.4. It was worse than anyone forecast. And there's a very high likelihood that Q2 that we are in right now will also be a negative quarter. And so they're very behind the curve. They should have started QT a year ago, arguably. Right. They should have started raising rates a year ago, arguably. And, they're in a really tough spot here. And I don't think that they are going to tighten as far as the market has priced in. The market's priced in like 10 rate hikes, all the way up to like 4% or something. That would be a new rate paradigm. And if core interest rates suddenly started breaking out above their 40-year downward trend, which has happened because of the debt-based system that we have, and the need for constant liquidity, the need for constant deficits. If we're trying to make the case that we're in a new rate paradigm and suddenly like the 10-year is going to be at like 5% or something, we're going to have to restructure the whole US dollar, because they're not going to be able to pay any of their debts. If you consider with $30 trillion of total public debt, 2% federal funds rate is essentially the cost of our defense budget on a given year. Like there's a solvency risk there. So you can't just let rates go up forever. They necessarily have to come back down. So I don't think that the market is going to end up being correct in how much tightening they priced in. They almost went too far. They did a lot of the Fed's job for them. And so that's why I think we've just been in this kind of pulpit, managing from the pulpit, where they're just doing a lot of sentiment. Because if you look at what the Fed's been doing the last 6 months, they haven't tightened anything. They've raised twice. It's very small. What's the federal funds rate? Like 0.5 or something? 0.75? It's very
7.5 to 1, yeah.
Right. They haven't done any QT whatsoever. They've literally just been telling us what they want to do, and the market has completely gone the other direction. And they're, because of everything you said, because what we're talking about here, all these deflationary forces that are outside of their control, they can't just let us collapse into a depression, right? We have to provide some backstop to the consumer, because it's 2/3 of our economy. And so there is a breaking point in this hiking, in this aggression. And the thing that it's hard for me to predict or try to present like a clear case for what that would look like is because of all this complexity, because the labor market is historically tight while we also have 40-year highs in inflation. That doesn't make a lot of sense. And there are a lot of people who I believe are still at home and they're comfortable. Now, granted, personal savings have been coming down. We see credit card, usage going up. People are employing leverage here. There's not a lot of spare cash, but I think that there is a psychological wealth effect that still lingers in the minds of Americans who don't live on the margins, right? The half of Americans who own a home, who still have gainful employment, that have a 401k with employer matching, like that's a big pocket of America. And those people are living a very different life from people who have service-related jobs or, manufacturing jobs, who, don't have a 401k, or maybe they just got into the workforce. They don't own a home. They have an apartment. They live in an urban environment where there are no homes, like you name it. They don't have the same kind of hard asset portfolio that some 50-year-old tech professional does that's been putting money into retirement for 30 years, right? Very different economic conditions. And so I think that's what makes that group, that group that still has some kind of prosperity, a soft target for the Fed to point at with their rhetoric until inflation comes down. They're praying to God that inflation starts coming down, because if it doesn't, then we have systemic issues that go far beyond any hiking cycle. And I don't really know what that scenario would look like.
Well, one of the inflationary pressures that have been out there has been a lot to do with the supply shocks, right? First of all, I'm right there in the camp of saying handing out all that stimulus while there was a reduction in supply and a reduction in production led to inflation. But the problem with what happened with that situation of what happened was it caused a lot of miscalculations by companies for their next year. So You know what? Let's pull up the tweet that Kathy Wood made the other day. So, obviously we've had the Walmart data come out, we've had the Target data come out, and they've come out and said they have a ton of inventory right now, right? So last year, I spent a lot of time bringing up the container shipping rates that were happening from China throughout the world into the United States, and that the cost of container shipping was astronomically high. And we were seeing like the cost of a shipping container being like $14,000, $20,000. Whereas in previous years, just the cost of the freight of sending these containers, it's like $1,500. So we're talking a 10x in the cost of these containers and what happened here. And what I speculated that was a issue that was actually happening is that people and retailers and companies were looking at their data from the year prior. The year when, in 2020, we had all the stimulus, you had all the people getting the additional unemployment, and then it didn't really slow down too much there in the first half of 2021, that they were still seeing these great sales, and assuming that they were going to maintain that same velocity heading into the end of 2021 and heading into the holiday season. And that what would happen is that they would over order, that they would think that they were going to hit the same numbers. And so then what they did is they were all fighting over this container space and causing these prices of these containers to absolutely skyrocket. And so now what we're seeing that they have all this inventory still. Target still has it. Walmart still has all of this inventory. And this is going to be a deflationary force in itself. But the thing was that the inflation that we have was from the initial shock from all the stimulus that happened back in the late half of 2020. People were given a ton of money. That caused its own inflation problem because people were fighting over limited resources with extra money. But then what happened was another inflationary force happened because everybody was fighting over containers the next year, and it caused a bottleneck in supply chains because they were all forecasting that they were going to do numbers the same as they did in the last year. But now here we are in 2022, they got it wrong. They did not have the same sales figures that they thought they were going to in late 2021, early 2022. However, they had to pay all this additional money for all this. So they had to work all that cost of those containers into the cost of their products. But if we look now, we could see that container rates are coming down. They're on the decline. They're down like 20% in the last couple of months and just heading in the downward trajectory. But what's going to happen here is now that they have all of this inventory, and let me just say this too, if for anybody watching this, I've worked in this industry for several years. This was my full-time gig, understanding the logistics of shipping and bringing 40-foot high cube containers across in cargo ships, and how you have to manage your inventory, pre-plan ahead, and all these things you have to do to forecast. It's the complete name of the game is forecasting in this retail inventory world. And what happened is they forecasted completely wrong, and they overpaid for containers, and they have a ton of inventory sitting there right now. So you have multiple inflationary forces that have happened on this inventory that they have right now because they have so much inventory. They have to pay additional warehousing to store all this inventory. They have to pay additional employees to have all of this inventory. And as for every minute that inventory is sitting there in their warehouses, which Walmart and Target said they're 30 to 40% over in inventory, that's costing them money by holding onto that inventory, and they have to let go of it. They've got to get rid of it. So if you imagine that, it's sitting in a warehouse, you're just paying for it to sit there. You got to find a way to get rid of it, because you're paying the warehouse costs, you're paying the employee costs to maintain all this stuff. What do? You run flash sales. It's time to liquidate this inventory and get it out because the consumer is getting weaker. We can see consumer sentiment is unbelievably low. We're going to see flash sales. We're going to see 30% off. We're going to see buy one, get one free. We're going to see come in and check out our recent sales so we can get rid of this inventory because it's costing them too much to hold on to it. And so we're going to see a deflationary price happen in a lot of this inventory merely because they overordered and they've got to get rid of it. They're going to have to take a little bit of a loss, which means when you look at their Q2 reports that are going to come out, they may have good sales, but they're probably going to show lower profit margins because they're going to have to take a temporary loss to get rid of this inventory. But imagine, you're going to see the deflationary force happen by them needing to run these flash sales to get rid of all this excess inventory that's costing them money to hold on to. But then what happens? What happens when that inventory gets massively reduced and they're trying to adapt to a new demand world? They suddenly have too many employees. they don't have as much inventory on hand. They don't have as much demand. They start cutting employees at the exact same time because they've all
And they have to start
forecasted.
spending money on orders again because now they've depleted their inventories. They need to start ordering more.
Yeah, but so the thing is, the point is, what has happened here is a 2-year period of stimulus caused over demand, then caused miscalculations by retailers, which caused rises in shipping costs, which caused more inflation to have to be baked into the goods that we have now. But the problem is, all these retailers are now sitting on all this inventory, and nobody's buying it at these prices. And so to get rid of it, there's going to have to be a deflationary force. And when that deflationary force happens, then they're going to have to let employees go afterwards too. So we have this already baked in. Like, this is coming. Like, and, that's my best guess. It's from me working in this industry and having to like forecast this type of stuff. That's the next phase of what's coming is flash sales. And that will automatically lead to unemployment because these companies can cut a lot of that extra workforce that they have. So I'm curious if this is all being accounted for in this rhetoric that's coming out of the Fed, or if they have to pivot because the market is doing it on its own already.
You make such great points, and I don't know how many market participants are really thinking it that's like second, third, fourth order effects, right? And most people don't take it that far. And Kathy Wood has been talking about double and triple ordering from retailers for a year and a half. She's been talking about it since late 2020. That would be something she thought would happen, and she didn't describe it as eloquently as you did, but you're describing all of the facts, and these things happen cyclically in the business cycle, right? Like this thing, we go through these phases, and after you have 2 years of record growth and stimulus, and you create an everything bubble, there naturally has to be a period of mean reversion. And I think, to your last question there, like how much of this is really being factored in by the Fed? I think they probably are aware of some of it. They got a lot of PhDs that work for them. Who knows how smart those people are? But, I imagine they expect some of this. And I think that they are hoping that the forces they can't control start to slow down before the forces they do control fall in on themselves. And that would allow them to soften their policy. So, I'm thinking that because they work on a lag, because all their data are lagging indicators, and they don't like to change their opinion on a dime anymore. They don't like to surprise the market. That's not Powell's MO. It almost never is anymore. He likes to lay seeds. And if they get something wrong, they will begin to slowly turn the boat, right? Unless the market utterly collapses, like in March 2020. That was a little different. But I think, barring a scenario like that, which no one wants, I think that it's just a matter of the lag that they work with over the next month. I think June is probably already written. Whatever they're going to do, they're going to start up quantitative tightening. They're probably going to hike one more time, and they're going to talk about how data dependent they are. And then by the time we get to July and August, because they don't even really have a meeting, I don't think, until September. But they have, they've laid out their plan. So we'll probably get this through comments and interviews and whatnot. I think that if labor continues unfolding, and we'll just call it retail, right? Because it's also the inventories, it's everything you're talking about. If retail generally continues unwinding over the next month or two, we may be looking at a scenario where late in the summer, where almost regardless of what the CPI report is, the Fed is already talking softer, because they can't allow the consumer to utterly collapse. They have to backstop it in some way because it powers the entire economy, and they can't have zero tax receipts, right? So there's forces, inherent survival forces that kick in at some point. And what I'm not sure about is what inflation looks like 2 or 3 months from now, because it's either going to have to fall from a serious deflationary shock like we're talking about, which would mean asset prices utterly tank, or it's still going to be kind of elevated, right? It's a month-on-month comparison. And because of the base effects of it, this time last year is when when the CPI was kind of flat. It really started accelerating a little bit later into the year. So we're at a weird period here where it might not actually start coming back down for a couple more months at an aggressive pace. It might come down a couple of percentage, a couple of decimal points. So I don't know. I don't know what's going to play out here. I don't have all the answers, but it certainly seems like their view of the market is very limited. Like if I just go right back here to that interview, this one paragraph sums up his entire thesis. And it's, we can't control demand. We can control demand. We can't affect supply. Supply is a big part of the story. The question about whether we can execute a soft landing is out of our control, but we can control the controllable. That's a stupid thing to say. And he says, what we can control is there's a job to do on demand. And in their parlance, demand is the tight labor market. It's out of whack with supply. There's more demand than there are people to satisfy it. So we can address that directly, and we will be trying to moderate it in a way that lets labor get back in balance and inflation back to 2%.
And what's interesting, though, is there's a lot of things that are factoring into supply, right? I mean, we have all different types of things that get factored into supply, whether you're looking at housing, energy, whatever. But what we just saw from Walmart and from Target is not what they just said. Walmart and Target are saying demand are not keeping up with our supply.
Right. Right. Yeah. It's interesting because retail sales are up, but earnings are down, right? They're spending more dollars in nominal terms, and they're buying fewer products with them. And it's interesting because they keep referring to demand as the labor market, but then we see this conflicting data coming out of retail. And that's why I think that we are headed for a collision between their stated intentions and what the market's telling them they have to do. But I don't think that they will be forced to change their mind until the data. What am I trying to say here? Like they're not usually the types to go, oh, things look nice. We're just gonna start softening our policy here. That's usually not what they do. They usually stick to their plan until they're given gross invalidation. So I feel like that's what we're heading for. And with what the last couple of weeks have looked like with retail, it might come relatively soon.
Yeah, and so that's the problem here is that, we can look at some of this data and see that there are demand and supply inconsistencies where there's forecasted demand is not going to meet supply. And so these retailers are announcing we have too much supply, but everybody thinks that if the Fed goes too far, will send us off into a Great Depression, and that they have to reverse course at some point. But nobody seems to know where that point is. Is that accurate to think that that's what most people are thinking? So, we try to read this stuff and we try to take it serious, right? If to see if it can give some signal into what's going to happen. But the data and knowing that they can change at any moment causes this confusion, right? I don't know if that's really the right word to use, but to draw a real conclusion from it, you can see what they're saying, right? I mean, the labor market is tight. Everybody's got a job. Anybody wanting to get a job can get a job. This is causing increased wages. This is causing everybody to feel a sense of security, and they're going around spending money, right? So they're like, we've got to get demand under control because we're overdoing it. There's not enough supply to meet all the demand that's out there. So we got to bring demand down.
And the thing is, I think that they're just looking in the wrong places, right? Like they're talking about demand purely from a labor perspective. But as we talked about a few minutes ago or earlier in the call, there are demographic things that are changing the labor force, fundamentally changing the labor force. The labor force, there are fewer people being born. There are a ton of people entering retirement, and there are just less people looking for jobs, right? So of course there's a disparity now. We've had a roaring economy for 2 years, and we gave a bunch of people money, and we created this psychological wealth effect where a whole lot of people felt like they never had to work again.
And
they could
imagine this too, right? And we're not going to debate ethics here for anybody listening to this who's saying, how could you want that? That's wrong. But the reality is, it seems like from the messaging and how to interpret this, does it seem like people who are cheering for an upward stock market and for the Fed to chill out, people are cheering for people to lose their jobs?
Yeah. They're people that are, I'm going to say it bluntly, people who are calling for a melt up here. Think about what would cause the melt up. It would be a dramatic Fed pivot. And what would cause a Fed pivot but an utter collapse in the market? It's not like they're going to wake up tomorrow, see CPI at 6%, and pivot to QE infinity. That is not going to happen. That's not the order of events. And
Well,
I think that,
that's not really what I'm saying, that we're going to have
is
like
that not what you're saying?
collapse happen. But what I'm saying is, like, when we see economic, like you had the unemployment data come out yesterday, right? It was a slight miss. There was more first-time unemployment claims last week. And when I saw that data, I'm like, oh, I guess that's what you want to see if you want the Fed to chill out on scaring the market. You want to see unemployment come higher than expectations. I'm not talking like a massive, like, millions of people loses their jobs, but
No, yeah, I don't mean the Great Depression.
yeah, but I'm saying, like, if you want the Fed to quit with this rhetoric, what people really want technically is to see more first-time unemployment claims. Is that right?
That's fair. And to be fair to you as well, I'm also responding to people I see on Twitter. I spend a lot of time in Twitter Spaces. I have a lot of discussions with people, and there's still, I feel, a fair sentiment out there that that thinks that we're just any moment now the Fed is going to go, oh well, things are tight enough. We're going to turn back on the liquidity spigot, and everyone can pile back into risk assets. And the disconnect there that I find with folks, and I'm not saying this to you because I want to add this for the listeners, is that conditioning, I think, was born in March of 2020, and by applying it to now, ignores what happened in March of 2020 to cause that. And part of it was the lack of liquidity that you described earlier in the overnight markets. The treasury market went no bid, which like never happens, the most liquid market on earth. The stock market, the S&P, fell 35% in a single month. It's not even 20% down right now from the all-time high in January. So there was a dramatic fall in the market in March 2020. Literally, the floor fell out. 20 million people applied for jobs. There were 2 market-wide circuit breakers in the same week, which means they shut down all trading on the New York Stock Exchange. I was actively day trading equities when that happened, and it was scary as hell. This market is not in that place right now. And so when part of my answer is born from when I hear folks hoping for a Fed pivot, the pivot would come because a bunch of people would lose their jobs. It doesn't have to look like March 2020, but that's the last time it happened, and it was because of the events I described. And we haven't seen anything like that. So I don't think that those folks who have placed their bets on a dramatic pivot of that type are going to win that trade yet. I think we need to see more unraveling. It would be more obvious.
Yeah, and for me, and I've been in this market since 2017 in the cryptocurrency market, and I started my YouTube channel in 2019, and I had kind of tracked out where I thought Bitcoin was going to go before we ever had the Fed interject in it. So even after the sell-off that happened in March of 2020, my target still remained, $70,000 there for Bitcoin. And then, all the events unfold, everybody gets all their money, and what do you know, the price of Bitcoin reaches out to that price level. But, it becomes this inner battle within myself, and this is me just personally, because this was always the target, right? The 4.236 extension on the Fibonacci extension scale, that this is where we were going to go. Yeah, but the thing was, the Fed narrative came along with it, right? So we're like following along precisely how Bitcoin has performed before. It still went up with it. And then the Fed narrative came along with it as kind of like a selling factor to go with it. But would the price have still done exactly what it was going to do regardless of Fed? You know what I mean?
Yeah, that's a hard one to answer. And maybe it would have, but on a different timeline. Maybe it would have taken a bit longer to play out for Bitcoin to have gone 20x from 3K to 60K. Like that maybe it would have not played out exactly like that, but we would have eventually gotten there. I mean, look at the
and there's no way to know. It's a hypothetical question, right?
Right, of course. Yeah. But like using your own methodology with the 4.236, just look at the disparity in the time between the NASDAQ and the S&P to hit theirs.
I know, it's insane, right? Yeah. Yeah, because it's taken the NASDAQ hasn't quite hitten it after a 22-year. It did get above the 3.618. The Dow Jones Industrial Average has gotten above the 3.618, not quite hitting a 4.236, but the S&P 500 has hit it, right? on a 13-year bull run, or 12 or 13-year bull run for the S&P 500 or the S&P. And you have also the NASDAQ after 22 years getting up to there at the same place. It's all majestic and magical, and how all that works out at the same time. Hard to explain, right?
It is.
And so, that's where it comes into the debate of whether or not, all of this analyzing of the Fed and, their movements, can you draw all the info out of it, what you need to make all the decisions here and there. It's hard for me. I wanted to share this with my audience so they could kind of see the complexities of everything going on out there, because I don't talk about the Fed a whole lot. I don't have the full understanding of the Fed and the ins and outs and the fundamental analysis of diving into the Fed at every moment, and especially when they'll change, right? So it's not, and just like they said in here, there could be geopolitical events or something that happens that's out of their control, that anything in the world can actually end up happening that changes what they have to do, like what happened with C19, or if the overnight lending market doesn't have enough money and they have to bail out. Like, things can just change, and we always sit here and try to analyze the Fed. But when you look throughout the last, just since 2018, how many changes have had, right? They were trying to raise rates in 2018, boom, they had to change, right? 2019, overnight lending market gets into trouble, boom, they're bailing out repo bailouts. And then, come into 2020, boom, C19 happens, boom, flowed the money into the thing. And so any fundamental analysis of them at any moment in time during all of those different periods, something happened where they had to change. And that's where we're at right now, of like, well, here's what the clear messaging is that they're saying, is that they're trying to control the demand function here. And by controlling the demand function, what they're really wanting to do is create unemployment. That's what it sounds like to me. And all the things that they want to do.
They have room. They feel like they have room to create some unemployment without killing the labor market. They feel like they can send a bunch of people out onto the street, and that those people will have jobs available to them.
Right. And so the thing that I also don't see them mentioning in here is that what we're seeing happening with, Walmart and Target, that's what everybody's dealing with. Amazon, whether they're publicly announcing it or not, the millions of Amazon sellers that are out there that operate in the United States, they're all dealing with the same thing. They've got too much inventory. There's a problem coming down here for these guys with all this inventory, and a deflationary pressure coming with all of those assets. And I'm curious if that's being mentioned by the Fed as a deflationary force on on consumables that's coming. And I don't know if that's factored in or not.
So there is another point I wanted to bring up that I think is relevant to our conversation here. And it kind of has to do with how much has the market priced in, right? There's all this talk about, oh, well, everything's priced in. Everyone knows about the tightening. Everyone knows about inflation. It's all priced in. Last week was the capitulation. Like, that's a narrative that's on Twitter right now. And I would propose that markets price in when factors are known, right? They price in all known information. But by virtually everyone's admission, we're in an environment where there are almost no certainties other than no one knows what's going to happen. So the amount of pricing in that could actually have occurred by this point in the market is nebulous at best, right? So I think that we have to assume that there are many outcomes that the market is simply not prepared for and would react to should they unfold. And part of that can be seen in the words of the other Fed governors. So I have on the screen here some comments by James Bullard, and they're from last week. It says that they are from 3 hours ago, but it was last week. And James Bullard is one of the Fed governors. I think he's the Philadelphia Fed or something. It doesn't matter. But he's probably the most hawkish of all the governors. And it's also important to know that if you're a Fed governor, you don't get to set any policy.
Can you explain hawkish?
Yes. So hawkish is tightening. Dovish is easing. Hawks are predatory. Doves are not. Right. So it's if the Fed is being hawkish, they are being anathema to assets going up. Right, that's bad for markets. Whereas if they are dovish, they are pivoting to easing. QE is dovish. QT is hawkish. That's the most basic way I can explain it.
A dove is gentle and nice and wonderful, and a hawk is a predator and attacks. Right.
There you go. It's in relation to the market. So So James Bullard is probably the most hawkish. He's the one he was the first one to talk about 75 basis point rate hikes. He was the first one to talk about quantitative tightening in January. He's the one that's been saying we should just rip the Band-Aid off and make it as painful as possible so we can get back to normal. He doesn't seem to care what happens to the stock market. But it's also important to point out that he's a Fed governor. He does not set policy. All right, Lael Brainerd, and who I believe is the vice president of the Fed, and Jerome Powell and one other person are like the triumvirate at the top of the pyramid. All the other governors, they get to make an appointment. They can come in, they can tell Jerome Powell what they think, they can plead their case, but at the end of the day, they have to fall in line with the head honcho. But Fed governors give a lot of comments. They go out in public and they express their views. And now those views are usually approved by the committee. It's in some way, but it's a chance to get to hear the discussions going on behind the scenes. So I laid all that out because I want to talk about what's on my screen here. These are some comments that all came from the same interview. So in this interview, James Bullard says, the most pressing issue is inflation. We have a good plan in place to bring inflation down. But then he also says, it's not exactly clear what the effects of shrinking the balance sheet will be on the economy. Shrinking the balance sheet is quantitative tightening, which they will begin in June. So he says, the most important thing is inflation. We have a good plan for inflation, but nobody knows what the outcome of our plan is going to be. And then he also says, we continue to expect above trend growth for the United States for the next 18 months at least. So in case anyone doesn't get it, none of these ideas are in harmony with each other. These are all conflicting ideas. We have a good plan. The most important thing is inflation. We don't know what our plan is going to do, but we expect growth to continue. What? So right. The people in charge don't even know what's going to happen. They're giving conflicting messages to the public. These comments go through approval, people. So that there is a clear disconnect at the Eccles building in Washington, D.C. about how any of what they're doing is going to actually play out. So it's hard to bank on the market pricing in any of this. That's my point.
I don't know. It's just so conflicting.
It is. And it's because so much of it is out of their control. And I think we need to be honest about the inflation thing. Inflation isn't really the Fed's fault. I mean, it's their problem to deal with now. But most of the inflation was caused by shutting down the global economy, as you said about an hour ago. I won't say that. As you said a few minutes ago.
We've been doing this a long time, yeah.
Right. But part of it was the shutting down of the economy, like you said a while ago, and also the fiscal stimulus that was approved by Congress, which the Federal Reserve is then required to adjust monetary policy in support of. So much of this blame needs to be laid at the feet of the politicians who chose to go this route. And the Fed, by its definition, was required to support it because it needed to uphold employment and price stability. And they did what they thought they should do. Now, they probably did too much, but they also fiscally stimulated too much in Congress. So I think there's a lot of blame to go around. It doesn't lay at the feet of Jerome Powell. What does lay at his feet is calling it transitory.
Right. And that this should have been done a long time ago.
Yeah, it is. And, so we've got a bunch of people in DC arguing about price gouging and blaming it on the corporations and all this, but none of them want to take responsibility for the fiscal stimulus and the inflation that was caused by shutting the economy down and giving a bunch of people money and then reopening. So I think there's a lot of it to go around here, and it just further makes the water more murky as to who is really in charge of fixing this problem and how the heck they plan to do it.
And whether or not the economic situation is going to have its own deflationary impacts regardless of whatever the Fed actually ends up doing. Because when you look at it from the lights that we've talked about, that it was kind of a series of events that created all the inflation, from the stimulus to the minimal supply to then the anticipation of oversupply to where now they're stuck with a bunch of supply, right? They have a bunch of inventory sitting, and whether or not that's going to cause its own deflationary impacts on its own, and will that cause all of this rhetoric to actually stop faster on its own, because the inflation will potentially come down on its own. And one thing we didn't point to on Kathy Wood's tweet right there is that that U.S. consumer sentiment is measured by the University of Michigan. The best measure in my experience has plunged to levels not seen since the 2008-2009 global financial crisis. Consumers are rebelling against their loss of purchasing power. So that we already have consumer sentiment incredibly low. And we already have an incredible amount of inventory sitting at these retailers, and that, one thing we haven't even touched topics on is in regard to housing, that there's potential for the housing market to cool off in there with these rising interest rates, and now it's like 5.5% to go get a 30-year mortgage. So you have an elevated price, the actual sales price. You have an elevated interest rate, and then you're going to have elevated taxes that go along with that, property taxes that go with it. That a mortgage is practically double from what it was 2 years ago, right? For the exact same house, just because of interest rates, purchasing price, and taxes. That and alone cool things off on its own. Do we already have these deflationary forces already there to cool things off? And does there need to be more hawkish rhetoric on its own, or is it more of just a public stance thing? I don't know.
Right. I don't either. And I don't think, to be clear, I don't think that all this hawkishness is really doing very much about inflation, because the inflation is already in the system. And at this point, much of it is being driven by the things we talked about the commodity markets and what's going on in China and over in Ukraine. Like, those are driving inflation in a lot of ways. And I think that there's only so much hawkishness they can really do. And at some point, it just becomes a charade. And I think we're reaching a point where because of how tight the bond market has gotten, it can't really go much tighter unless someone's going to convince me that we're entering a new paradigm, which I'm not convinced of. And so there is a point where the charade meets harsh reality. And I think a lot of these deflationary forces will be that meeting, and it will probably come sooner than the Fed is expecting. And it'll probably be after they've already started quantitative tightening, and their response will be interesting.
Yeah, in like the charade, right? We know that politicians live to take credit for things that maybe they had nothing to do, and they like to cast blame in other directions for things that are clearly their fault. But, one of the things is that, he was denying that inflation, was real and that it was transitory, because you can go ahead and you can make the argument that, let's say that if in May of last year, right, all of this inflation is transitory stuff is back in, March, April, and May of last year when markets are topping out, right? We're getting an opposite signal that everything is fine from the Fed. They were telling us everything is fine. But what would have happened if they actually did switch hawkish then, right? What if they did start saying, hey, we're going to do these things, but inflation still continued to ramp out of control? It would have looked really bad for the Fed if they were actually trying to implement real world tools to fight inflation, but they couldn't stop it because people were still going to be forecasting based on the previous year's numbers and still going to be fighting over container spaces. And inflation would still have kept going no matter what, even if they implemented that. And the only time they could wait for is they could wait for right now that inventories are oversupplied, and they can say, hey, we want to fight inflation now, when the deflationary forces are already coming, and it just makes them look good because they're coming anyway, right? With over inventories at all these places. The deflationary forces on consumables seem like they're going to be coming down if they have to sell off all this inventory and quickly, but it can make the Fed look better here. Whereas if they had done it a year ago, they couldn't have done anything to stop it.
I think that's a really good point, and it's something I hadn't really thought of through that lens, but I think there's a lot of merit to that, honestly, BCB. And it's if they had started too soon, I think you're right. Like, they would have been enacting measures while baseline inflation was continuing to go up, and it would have shattered any credibility they have. And, here we are in a midterm election year where the voter base cares more about inflation than anything, than abortion, than climate change, than corruption, you name it. It's inflation, number one. And so I think that that's why we're getting so much rhetoric about it. Because in my opinion, the Fed, like, they know they can't do anything about it. They know they can't. They've expressed that they can't. And so I think a lot of this is maintaining order, because otherwise you're looking at potential civil unrest. If you just don't take this issue seriously, when it's the most pressing need on American society in 40 years, like, people would riot in the streets, right, in an election year. And I don't think anyone wants that. So I would posit that there is also an immense political pressure. Now, we know that they're an independent body, but they're in the same city as the government, and
Right.
they're just a phone call away. And I guarantee Biden has Powell on speed dial. So there's probably a lot of that playing into this also.
Yeah. And I think that's probably a good way to kind of end all of this, is that we can kind of see what the messaging is that they're bringing out there. Obviously, the stock market has been rough, right? It's just been downtrend for months at this point, and with no signs of reversals coming in yet. Obviously, cryptos have been impacted by all of this at the exact same time. But there's just so much to think about when it comes to trying to analyze the Fed, that I can think of all these different things, as I've kind of like showed like how deep my thought process goes in here, and how you can try to read it, but then you can question it, and then it doesn't, not everything adds up perfectly, which makes it real hard for me to be able to read them clearly on what they're saying. I can see what Powell is saying. I can see it very clearly, but I can look through the last couple of years, and I can see how flip-floppy it can become when things change, that they can change on a dime really quick too. And I can look towards these inventory numbers that Kathy Wood is pointing out here for Target and for Walmart, and knowing that from working in this kind of industry, that you want to get rid of this inventory as fast as you possibly can, because it's very expensive to hold on to it. And it's not just Walmart and Target that are going to be having this problem. This is going to be a massive problem everywhere, that everybody fought over container spaces. They all tried to work that price of those containers last year into their goods. And now they're stuck with all that inventory, and there's going to have to, and some companies are going to decide, we're going to go ahead and sell a lot of the stuff at a loss or break even just to get the inventory out to free up warehouse space. And then there's going to be some that sit there and hold on to it and still try to recoup the costs and do it really slowly over time. And we'll see some companies probably fade, and some companies survive, but that for the brief moment here, when it comes to inventory, I would assume that we will see a reduction in the prices of the goods that we buy at stores due to this. Will that impact the CPI prints? Will that impact what the Fed's rhetoric is? And will that impact sentiment for the positive? And that's kind of the conflicting thing in here, is that we want to see unemployment rising. We want to see prices being slashed and profit margins being slashed at big box retailers, because if those things happen, the Fed will cool off on trying to be so hawkish, and then that's bullish for stocks. Just that whole sentence right there is insane to even say. You know what I mean?
It was crazy to hear you say it.
But that's it, right?
But it is.
Yeah.
That's it, though. And that's it. And unfortunately, because we have so much history on how they tend to react, they're usually not proactive. They are reactive, right? Because everything is on a lag. And what would cause their reaction would probably be some higher unemployment numbers, some worse earnings reports from various important companies in America, and a deterioration of growth outlook. Like, that's what would cause them to change their minds. It's not a scenario that anyone should wish for, but if they don't change their tune and inflation doesn't improve, it's a likely outcome, right? So hopefully some of these deflationary forces actually start to manifest soon, and we don't continue to have supply shocks in commodity markets, which I do not understand in their full depth. And there is much more like geopolitical complexity that goes into that's being disrupted by the war in Ukraine and the regionalization of supply chains from cutting Russia out of SWIFT. Like, that created a major inflationary force that we didn't spend a lot of time on today,
Right.
because I don't feel qualified to really give opinions about that in any way. But that's something that I don't think gets enough attention from everyday market participants, and they're just kind of assuming those things will go away because high prices are the solution for high prices. But if you have systemic production issues, like if the harvests don't produce, or oil manufacturers are disincentivized to invest in production as they have been, those things doesn't really matter about demand. Prices can stay high until those issues are fixed. So I think that is colliding with all this other deflationary stuff, and it's anyone's guess as to which force is going to win.
And I think that was a really good point, because we both started this by saying we're not Federal Reserve experts. Realize we're a couple of dudes on the internet having like a podcast show where we're just kind of unqualified to know the ins and outs of all of this, but talking about the things that, maybe we do have a little bit of knowledge on to kind of chime in on. But that there are so many more impacts, and there's going to be people who are listening to this saying, you're missing the fact about this, you're missing the fact about that, this is super important, this is a big thing. And I don't know what that is, right? But what I'm saying is there's people listening to it saying these are the factors that you're not including in there. And there are, and that's why it's so hard to read the Fed. And whether you're thinking about inventory levels and what's going to happen with inventories and deflationary impacts, or whether or not there's going to be the ability for oil prices to come down and gasoline to come down, or whether or not that demand is going to cool off on the housing market at the same time while the interest rates are rising, prices are rising, and property taxes are rising. All of these factors make it all so, complicated. And just this was kind of a fun exercise. I had a really good time doing this with you. But in the end, this is the confusion of being able to analyze all that. The reason I wanted to do this too, I thought you did a phenomenal job on your video. But I get asked, what do I think about the Federal Reserve? And I kind of touched, what a lot of my thoughts are, and the confusion of being able to interpret the Fed by having this discussion with you. But I don't know all the answers, and I don't think the information exists out there for me to be able to make the perfect assessment of what's going to happen with the Fed.
Right. Yeah, I don't either. And I'm certainly prepared to hear from folks who think, TX, you're not considering all these factors. I heard you talk to BCB and you guys didn't even mention XYZ. Please put those in his comments. Like, let's generate some discussion. Tell us what we're not missing. I would love to go learn more about these things and fully round out my perspective on this, because I think there isn't anyone who has it all figured out. And, we really need to do some kind of crowdsourcing research here if we actually plan to make sense of any of this. And, but I am the type of person where I'm driven to try to understand things, right? Like I get uncomfortable when I feel like I have no idea what's going on. Mm-hmm. And so where I spend a lot of my energy is trying to listen to other experts and trying to coalesce their viewpoints into some kind of reasonable thesis that makes sense to me that I can then use as a foundation, right? And so it's a continual process. And this is the most complicated market that anyone alive has ever had to deal with, ever. The amount of different factors weighing on market outlook right now is obscene. And so I think that we all just need to be a little patient, not get too excited to call bottom or call top or call reversal, and allow this to unfold a little bit. I think it's going to take a little longer than people expect, this whole process, and it's not going to look the same as some previous fractal, right? Because we're in a totally new environment. So it would make sense that the market behaves in a slightly different way than we're accustomed to. And that just makes forecasting exceedingly difficult.
All right. Well, my dude, I appreciate you coming on here. Could you pull up your YouTube channel for me? But yeah, and I agree. And it makes one of these times very challenging. Right now is one of the more challenging times for me as well right now. And trying to make sense of a lot of the things that are happening. And you could see all the different things that are happening out there that make it so complicated. And dude, I really appreciate you coming on here. I always have a good time chatting with you. We chat more than just here on the YouTube channel, but I always enjoy and value your insights and chatting with you. And I appreciate you coming on here, man. And everybody, you could check out his own YouTube channel over here, which is Alpha Beta Soup with TXMC over here on YouTube. You can go give him a subscribe. But man, thank you for coming on here. Thanks for engaging in this conversation with me. Whether or not we found all the answers or anything like that, I think we touched on a lot of the topics of at least what the Fed is doing, whether or not any of them whether or not we drew any conclusions out of any of it. But I think, we touched on it all, right?
Yes, we did. And I'm really appreciative of you having me on here. You've been a big supporter of mine since I started putting out content. And so I really appreciate the chance to come on here and chat with you. I really admire your perspectives, and I've learned a lot from you over the years. So this is a treat for me. I consider you my friend at this point, but I'm also a fan of your work. And so this has been really great. And I'm just glad to be here, and I'm happy to come on anytime you want to talk about anything.
Brother, I appreciate it. And yeah, I'd love to make these more regular. I think they're fun. And the audience, people comment and they say that they enjoy them. So we'll see if they like this one. This was probably, this might be 2 hours long. I don't know. But we'll get it out there. We'll see what people say. And I enjoy doing them, and we'll probably do them again in the future because people do seem to like it. But again, thanks, brother. I'm going to go ahead and do my outro right here, and then I'll say goodbye to you afterwards. But let's go ahead and wrap this thing up. That's it. Thank you guys so much for watching. Thank you guys so much for watching. If you could, please like this video and give it a thumbs up. If you're new to the channel, please subscribe and hit the notification bell so you could be notified of when I create new content and when I go live. As always, this is not investment advice, and I am not a financial advisor, and neither is TXMC. But if you ever need a pick-me-up or a little bit of reassurance, just remember that the blockchain backers got your back. Have a good one.